Hello, fellow risk takers, and welcome to my worst investment ever. Stories of loss to keep you winning. In our community, we know that to win in investing, you must take risk, but to win big, you've got to reduce it. To join our community, go to myworstinvestmentever.com and receive the risk reduction checklist I've created from the lessons I've learned from all of my guests, and get my weekly email to help you increase your investment return. Also, in the community, you will receive a super special podcast listener discount on my 6-week valuation masterclass bootcamp. This bootcamp is for those who want to learn exactly how to value companies like a pro and advance their career in finance. Go to myworstinvestmentever.com to join our community for free, fellow risk takers. This is your worst podcast host, Andrew Stotz from A Stotz Academy, and I'm here with featured guest Axel Meierhoefer. Axel, are you ready to rock?
I'm ready. Let's go.
All right. Well, let me introduce you to the audience. Axel Meierhoefer was born in Germany, served 22 years as an Air Force aviator and instructor. In 2005, he started his consulting company and then discovered real estate investing during the recession. Now, experiencing financial freedom, he wants to share his secrets and his life lessons with all of us. You can find him at his Ideal Wealth Grower YouTube channel. Axel, take a minute and fill in further tidbits about your life.
Yeah, thank you, Andrew. Well, you pretty much summarized it very well. The only other thing I would say is when I retired from the military, I tried being a regular employee for a company. And then, like you said, in 2005, started my own business. And that's pretty much the only thing. And I'm still doing the same thing these days. So,
And
yep.
when you started the consulting, what area of consulting is your area of specialty?
Well, this is a little bit of maybe a tangent to what we're actually going to
Yep.
talk about. It's a little bit of a funny tangent, maybe. So I was absolutely convinced, like you mentioned, I'm an instructor in the military. I had a pretty good standing, saw a lot of things, so I thought that would be interesting to companies. And when I started consulting, I thought I would just stay in this, like military defense contract area, lots of money there, training people in cool stuff and so forth. And I got asked by another consulting company owner if I could help on something completely off the cuff where Schering Plough and Merck, two pretty big pharmaceutical
Yeah.
companies, had merged. That's what they called it. In
Yeah.
reality, one
Crashed.
bought the other. No, one bought the other, right?
Okay.
It was really an acquisition. But one thing I thought that they did was actually quite smart is to say, okay, on the Merck side, let's look at all the processes and things that we're doing really well. Let's look at the sharing side and look at what they do particularly well and then identify the delta. And instead of us trying to pretend as if we suddenly knew just because we came together how to do it better, let's bring in some people from the outside and let them take a look and make some suggestions. And without going into too much detail, they had like a horrendous and unbelievably expensive process of basically telling the regulators, meaning the FDA, that they made a change in their marketing. And to keep this kind of like a little bit lighter, I always said, when I first asked, can you tell me the most egregious, which lines up well with our discussion, right? But in a different area. So the most egregious example of how this works. And the guy that I talked to said, well, think about this. This happened last year. We have 9 people on this committee, from like really highly paid 6-figure lawyers to other people, experts, scientists, and so forth and so forth. And the company leadership decided to retain the same design Christmas card, but change the year naturally. And 9 people had to come together in a room and each and every one sign a form that was submitted to the FDA for this particular product that the Christmas card was for, going out to all the vendors and clients and stuff like that. And the only change was, I think it was from like 2003 to 2004.
Oh my
like,
God.
like
That's
so
hilarious.
so
And
they said, well, this is kind of what we're facing, and we're looking for people who can change this. And so I tapped into this. And you mentioned this earlier, pre-show, right? Like, German structural thinking
Yep.
and efficiencies and stuff, and came up with an approach. And I briefed them on what I think they should do to avoid a lot of time, a lot of pain, a lot of cost, and so forth. Did that. Everybody was seemingly happy. I thought, okay, that was cool. And now I go back to my military defense training kind of stuff. And a few weeks later, I get a call and they said, we really like what you came up with. This would be a significant change to the procedure that we have been doing before. Could you train our people? Since you developed it, and you are an instructor, you should be probably the best person to train everybody. And I'm like, sure. I mean, training is training in a way.
Yep.
I do that. Well, little did I know that meant 500 US marketing people and 250 global marketing people. So for 2 years, I trained people in the Merck Training Center in Pennsylvania on how
Wow.
this process worked. And I still claim, I said this has a little bit of a funny twist, that somebody in that Homewood Suites hotel right next to the training center one night came along and tattooed an invisible ink pharmaceutical industry on my forehead. And ever since, I've only
You've been
gotten
in there.
pretty much 90 whatever percent working in the life science and pharmaceutical industry. So, the short answer to your question would be, how does a military aviator and staff officer end up being a consultant in the life science industry?
There you
That's
go.
how it went for me.
That's amazing. Yeah, and one of the things that I always have thought all my life is, that's the value of competition too, because big companies that are really big, maybe that are highly regulated, you know, the truth is there's so much opportunity, and that's where I love. Yeah, it's one thing. I worked in Pepsi in Los Angeles, and I saw a lot of the same type of thing. And even though it's competitive and all that, the reality is that without small competitors coming along trying to eat your lunch, sometimes you can really get off track. And so I always appreciate in America we had, when I was going through university, we had something called students in free enterprise or something that was trying to teach young people that the value of small businesses, and small businesses can either take over big businesses over time, or they can make big businesses better. And so the waste is huge.
Yeah, absolutely.
Yeah. Well, now it's time to share your worst investment ever. And since no one goes into their worst investment thinking it will be, tell us a bit about the circumstance leading up to it, and then tell us your story.
Okay, yeah, thank you. So the story basically starts, and the setting of the story starts in a way with me transitioning from having come to the United States as part of an exchange program to fly F-111 fighter jets for the US Air Force. And when that finished, I thought, and my family, my wife, and we thought we would go back to Germany, but we were told, and not in those words, but that's my interpretation, peace had broken out, unification in Germany, and blah, blah, blah. And training should no longer be done in aviation in these densely populated areas in Europe, but should be transferred to less densely populated areas, like, for example, New Mexico. And since I was already stationed in New Mexico as part of this exchange program, they said, well, you know the language, you just finished your term at a US Air Force base. We have signed a contract at another US Air Force base about 300 miles further south towards the Mexican border in El Paso area, where we want to develop a German flight training center together with the US flight training center for what at the time was called the stealth fighter, and then train together. And to get this out of the ground, we need to have somebody with experience dealing with both sides, speaking the language and all that stuff, and manage the project. And so you have been chosen by some of our leaders here in Germany to be the program manager for this new flight training center. And so I moved there, and you have to keep in mind this was happening around the year 2000, right? Like late 90s, early 2000. And with this transition came the need for a lot of people being put in. Initially we were about 100, and then it grew to 800 people from Germany, all kinds of different ranks in a desert town in New Mexico, basically. So there was a lot of need to really do relationships building and engagement and stuff like that. And the media, I mean, not like social media, what we have right now, but the amount and the type of media that was common at the time was constantly drumming how necessary it was for everybody to be in the stock market. And this amazing future coming our way, this amazing technology, the dot-coms, everything will be automated, the robots will rule the world, everything will be on internet and websites and stuff like that. And in a nutshell, basically, you would be an idiot if you wouldn't try to participate. And at the time, and I have to admit, at the time, neither myself nor most other people I was with had any idea what was like a blue chip stock or a penny stock or anything like that.
They didn't teach you that in the military.
They didn't teach that, no. They taught us how to train other people how, to fly a fighter jet and drop bombs and shoot missiles and all that kind of stuff. But one thing that was the real fascination initially for me and for like a core group that became almost like a tiny little investor club was that it didn't really take a rich person to start participating, because these penny stocks were relatively cheap, like well below $1 a piece. So you could buy like several hundred or several thousand, because as good Germans, we always thought, well, if it's not a substantial number, it wouldn't make a difference. And for anybody who can remember that time, there were all these stories where people, it sounded almost like overnight, but in reality, even we were realistic and typically Germans skeptical enough to say it was probably not overnight, but within a year or a few years to really reach amazing levels of growth in the companies. They collected VC money left and right. Stock prices exploded from a few pennies to a few dollars and stuff. And one thing I always have to say, a little side hit at my American friends. One thing we learned in Germany, regardless military or not, is like the basics of math. Right? We can add, subtract, divide, percent, that kind of stuff, basically without having to take out a calculator. And so you just looked at these stories and these numbers, and it became very obvious there is money to be made. And so initially, several of us started doing this on our own. I actually felt, hey, you know, this is also kind of like an opportunity to build community by doing it together, talk about it. And we started this little club-like thing that initially met once a month and then more or less every other week. And in a sense, it was cool because we got to know each other on a different level. We got to feel into who is really kind of out there and adventurous, and who was more holding back, and I was kind of more in the middle. But we all made money, and we started having these kind of amazing dreams. Like one of my friends had started handing around pictures of the BMW that he would buy himself from the And one thing that the audience needs to keep in mind is these military assignments typically have a pretty fixed, determined end time when you get moved to the next place. It was a little different for me because I was basically allocated to get this thing to the finish line. Almost everybody sooner or later came and went. And so we literally not only saw the news about the gains, but we also had cases where the one guy actually did get his BMW. He sold everything and bought the BMW. And there was a crazy deal where you could claim at the time diplomatic status as a military member in the United States. So you got the car without taxes. BMW literally shipped it from Munich to New Mexico, no taxes. And when you took it back, it was part of your moving inventory. Right?
And for young people out there, in those days, if you could buy a BMW, you were rich.
Yeah, you were totally rich. And the other friend that I still vividly remember, he was a staff sergeant, and his family had a farm. And he had seen how many of the people in the rural areas there in New Mexico had these massive Ram trucks with double wheels in the back. And they were not cheap by any means. So he had to not just use some of the gains he had made with the stocks, but he basically saved. He had all along been saying, when I go home, I get one of those. But the stock gains actually helped. So he's the other vivid example.
Yep.
I had made all kinds of interesting ideas and goals and stuff of what I wanted to do. And had basically believed that it wasn't so specific when you actually needed to do it, right? The one guy did it a year ago, then the other guy with his big Ram truck did it 6 months ago. I thought, well, I can do it maybe next year. And then the market basically fell out pretty quickly for anybody who was around at that time or remembers or read about it. It only took, I think, like a month to lose amazing amounts of value in the stock market. And so I actually didn't get to do any of those things that some of my friends did. And it was very devastating because the amount of money, right? I mean, in my case, it was literally $75,000 of, I still to this day, right? I mean, if you start asking me questions about it, Andrew, I would probably still argue in that way. It was, in a sense, vapor paper money that I never really had. But on the other hand, I'm realist enough. Had I at any point in time when my friends bought their BMW or their Ram truck had sold, then I would have had the money and could have done anything like that or other stuff that I had in mind. So it was, gains, yes, and it wasn't really money that I ever got my paws on, so to speak. But it was my money, basically. The value of the investments had accumulated to this point, and so $75,000.
Yeah, when was the point that you realized it's all gone, or like it's not going to be, it's not going to ever really come back?
Well, it didn't immediately plunge completely down, like from like 100 to 25 in one day. But like I said, we had these bi-weekly meetings, so we saw a little dip, and we said, oh yeah, there has been volatility before, no worries, it's going to go back up. Then 2 weeks later, and it's not that we never looked in between, but you kind of, the worse it got, the less you wanted to talk about it. So the next meeting after, we were already like, I would say like 40% down. And I remember that meeting we discussed, should we just sell everything? We were still all pretty much in the plus. And ultimately, I would have to admit, I probably didn't really literally lose money in the sense of, if I compare how much I put in those 2 years and how much, after all, when I basically liquidated, I got close to what I put in back in, but it was still 75,000 less than what we could have had. And it took us basically a month, and by that time it was literally too late. And anybody who lived through that can tell how long it took the NASDAQ to even come close to where it was before. So
so how would you summarize the lessons that you learned from it?
Several things. One of the really core lessons was, and it took me a long time. It might sound like in our conversation as if that happened overnight, but it took a long time for me to analyze, again, maybe in somewhat typical German fashion, why did I behave the way that I behaved? And the answer that I'm still giving today is that I was much too willing to buy into the Kool-Aid, or drink the Kool-Aid, if you want to call it that, rather than really become knowledgeable, right? It was a thing that I really didn't fully understand. I just saw the news, I saw the stories, I got fascinated, and I thought, well, I can do $100 or $150 or $300. Anybody can do that, and never really spent the time to understand. We were sounding like we knew something because we were discussing the percentage gain, 2 weeks ago versus now, but we had no understanding what is a price to cost value, or price to cost ratio, or why are these companies growing, or do they have anything, like do they have either any kind of IP or any kind of facilities or any kind of assets or anything other than hype, right? None of that. I mean, none of that. So one of the core lessons I would say was, and I really live by this now, many years later, 20 years later, that I only get involved in stuff kind of like Warren Buffett, right? Like, I don't do anything anymore that I don't understand. And if it's initially interesting, then I'm going first into the research until I'm satisfied I understand, I believe I understand it well enough to commit money to it. That is one of the things I didn't do. And the other thing is, it might sound like this would be a generalization to the stock market, and I think that would be unfair, not because I'm a big stock investor at my age right now, but the point is, if you do the research, then there are organizations who have great IP, who have great assets, who have reasonable price to value ratios and stuff like that. And then there are plenty others that it's just kind of hype, right?
Yep.
Or somebody, convincing the lemmings to all jump into the same direction. And
Yep.
that distinction, I wasn't able to make that distinction at the time. And so now I'm basically, and this is why I have Ideal Wealth Grower. It started as my retirement plan because I decided I needed to do something that I understand and that retains value.
Right. Got it. And maybe I'll add a few things that I take away. For the listeners out there, what Axel's talking about is the dot-com boom. And
Yeah.
to put things in perspective, while you were talking, I pulled up some charts and some graphs. And Robert Shiller has great data on this, what's called the cyclically adjusted PE ratio. Basically, what he's doing is just taking the earnings of companies over the last 10 years, 10 years, averaging them, and then saying what's the price for those earnings. And just to go back in time, if we look at the peak PE ratio going way back in time, the first peak of the data that he has was in 1901, and the peak of the PE ratio was 25 times. That was massive. But it wasn't as high as the 1929 boom, which was almost 35, right? About 33 times PE. And then we had almost a 90% correction and the Great Depression. So let's put the dot-com bubble in perspective. That was about 45 times PE. That was the highest bubble that we've ever had as far as PE is concerned. And it went from basically, when you probably started looking at the market, it was trading at around 20 times PE, and then it went up to 45 times PE, and then went back down to 20 times PE within, a couple of years. And as you say, it took years to come back. So the reason why I say this is because I think the lesson that I take away, and I want all the listeners to think about, is that when you look back at price charts, you can say, why didn't we sell right then? It's because you get caught up in the emotion, like you said. And so one of the lessons I've learned in my own career as in the stock market is you really never can know the future, but you can know the present. As someone, I can't remember who said it, it's like, I'm on the cutting edge of the present. Like, I know where I am. So let's put that in perspective to today. So if the PE during the dot-com bubble was the highest it had ever been, at close to 45 times PE, and you, as well as many other people, got trapped in that, where is the PE today? Well, according to this data, the PE is now at 37 times. So we're only slightly below the dot-com bubble. Now, you can say what happened in the crash to the dot-com bubble was that so much of the profits there were no profits. So we were all being sold a dream there. Now you can say, okay, there's a lot of profits underlying the companies right now. And the global economic shutdown basically destroyed a lot of competition. So the surviving players actually probably have a lot of profits. So you could argue, well, maybe that's going to go from 37 to 45 or 50. Could. But I just want everybody to know that this is a great lesson from Axel to think about where things are. And the reality is we are closer to the top of a bubble than we've been in a long, long time. Does that mean it can't go up? No. But if you know where you are, it can help you think about what you do. So that's the lesson I take from it. Is there anything you'd add to that, Axel?
Yeah, I mean, one of the things that goes together with what I said earlier about understanding more of what you're doing, why you're doing it, and how it functions is that, the Schiller index or any of those different tools that are out there and charts and things that are out there, when you start studying it, you still would have to say, okay, how does the actual underlying foundation work, right? And if you just take the example of the S&P 500, right? And keep in mind, I'm no longer a stock investor, but I'm still researching things to always try to stay up to date. And what I would say is what very few people pay attention to is how these 500 are actually put together. And it became recently pretty public when Tesla entered the S&P 500, and a bunch of companies had to be taken out to kind of rebalance the whole thing. But what it teaches somebody who says, okay, my lesson learned is to really try to understand above and beyond just the individual stock or the underlying company to the stock, is to say, okay, well, if it now looks like it's 37, but it's 37 for the kind of companies who are the biggest right now, which is vastly overvaluing technology, whereas you and I are not constantly buying a Tesla or putting solar on our roofs or stuff. The only one in the technology space where you could say we're really participating daily is kind of Amazon, right? But most of the other ones are not. And so that's another component to keep in mind to really get that understanding. Is it really fair to say the S&P 500 of 2021 compared to the S&P 500 in 2001 versus the S&P 500 in 1921? That was completely different from what were these kind of companies and how representative of the economy were they really, and how does it look right now? Which in a long way, I'm just saying, I think this is even more dangerous if you ask me, because of how the weighing has shifted to what it was in the past, which might mean 36 is already similar to 45 in the dot-com bubble. But to me, the other thing that I would say as a lesson learned, beside this kind of getting to understand what you're doing, is to also really, in a nutshell, if I bring it to the point, and I do this oftentimes in Idea Wealth Grower, is whether it's on the videos or podcasts or so forth, is to say, don't forget, or maybe make this your number one thing to first ask yourself, what's the purpose of your activity, right? And I'm being asked these days most often, is it too late to invest in real estate? And I'm saying, well, ask yourself, what is the purpose? If you say, I want to invest in real estate because I want to get passive income, positive cash flow, to get ultimately to my time freedom point where I don't need to exchange time for money anymore, then the figure to look at that is, can I get, this is at least my advice to you, your listeners, anybody who comes to me, is I want to keep it simple. If you find a property that pays you $1,000 in rent, then you shouldn't pay more than $100,000 for it. If you pay $150,000, you need to make $1,500. Now, as the market kind of goes more and more crazy, it's harder and harder to find these, what I call well-performing properties. But if you just apply that rule, then you know that your purpose of making positive cash flow from day one will be met, no matter what. It is just mathematically impossible not to meet that. Now, if you say, well, the same place costs 120 now, and now they want 150 because everything got more expensive, but I don't get more rent, you're violating your principle, just like I violated the principle of knowing what I'm doing when I invested in the stock market. So coming down to say, what is the purpose of my activity? And from that purpose derive some clear criteria and principles that you then apply no matter what, also keeps you safe. And I think that's an important thing. It's not so much should you do, like I'm now recommending, real estate investing, or should you go back in the stock market, or should you invest in gold or Bitcoin or whatever you do. As long as you can really understand it and then derive the purpose and your principles from it, any one of those could work.
It's great advice. And the idea, there's two parts. One is that one of the things I loved about finance, and I've been doing research for years valuing companies, is I always want to dig down deeper. Like, okay, what's causing that? And then once you start digging down deeper, you start to find even more questions, and it's a never-ending cycle of questions. So, for instance, let's just look at another thing that makes it potentially more dangerous today. When the dot-com bubble started, the long-term interest rates for government bonds was about 8%. When the dot-com bubble peaked, that had fallen to about, let's say, 5%. That was a big fall, and for people that don't understand that basically means stock prices generally go up when the stock market is, when interest rates are falling. But if you look at this current rally from the 2008 bottom to today, long-term interest rates have gone from about 4.5% to about 1.5%. So it's been an absolute massive decline in interest rates that has pumped up that PE. And now you face a situation where interest rates could start rising, and when they do, what we'll see is that that PE will start to come down. So yeah, there's so many different factors, and I think for the listeners out there, I think the challenge that I've written down from what Axel has taught us is identify your purpose and then determine your principles. And as you do that, it gives you a foundation for what you're doing, not just chasing, the ups and downs. So for me, that's the biggest takeaway. Let me ask you, based upon what you learned from this story and what you continue to learn, what one action would you recommend our listeners take to avoid suffering the same fate? Think about it. They're in an investment club right now, talking about the
Yeah, right.
amazing gains that they've made and all of that.
Right. Well, for one, I mean, there are a couple of different ones. One is, I would say, don't be greedy, right? Like if you have been lucky enough to follow your principles and follow your purpose and things have worked out really well, there's nothing wrong with taking something off the table and put it into something that still has all its potential ahead of it. And I'm saying this deliberately in this abstract way because you need to do the research to find out which one is the one for you. Is it gold? Is it Bitcoin? Is it real estate? Is it stock market? Is it something completely different? Like, I don't know. I've been
Yeah.
recently contemplating to invest in a cacao farm. So
Yeah.
whatever, but it comes back to do your research, but don't do it while you kind of have these greedy eyeglasses on to say, where can I make another couple of percent to increase my already amazing gains, right?
Yeah.
I mean, the one lesson that I have learned, and it is regardless, is most people cannot time, regardless which market you look at, exactly where the top is.
Yeah.
So you have to basically manage your greed. But the other part is from a behavior perspective. And it might sound weird, and you have probably had many, many of your guests say the same thing, but I would say if you want to participate, if you see all this, what some people might call craziness or lack of participation for certain groups, I would say it's not a matter of can you be part of it or not, but can you be disciplined? And that goes back to this, the richest man in Babylon kind of book. If you can be disciplined enough to put 10% of what comes in away into an accumulation account before you ever get your paws on it, make it
Yeah.
automatic, let it come away. Then while it's accumulating, you do the research for the thing that kind of tickles you, whether
Yeah.
it's stock market or real estate or gold or Bitcoin or whatever it may be. And as you do this and you give yourself anywhere between 6 and 12 months to learn, that's plenty of time to get the accumulation account to be something big enough to really do something with it. And then you can do an informed decision of putting your money into whatever you find serves your purpose. That will be my advice. And if
Okay.
you follow that, then there is no exclusion. The thing that frustrates me the most is that a lot of the people come to me and say, hey, I read or heard something on Andrew's podcast or so forth about real estate investing, but I think this is only for rich people. And I always say, as long as you don't define a rich person to be able to put $15,000 or $20,000 together, then it's not for rich people, because anybody, I believe, can put $15,000 to $20,000 together, and that's the entry fee for the first property.
Okay. So last
Today.
question.
Yeah.
What's your number one goal for the next 12 months?
Well, I want to get my portfolio grown in my real estate property portfolio by another 2 or 3 properties.
Exciting. And is that going to be in the same region, in the same type?
No, actually, I'm trying, and this might be surprising for you. I have investments in Ohio and some in Idaho and some in Illinois. And so my new place, where some, maybe all of these are going to be, is Alabama.
Okay. Interesting. Well, we look forward to learning more. And listeners, don't forget to go to the YouTube channel, right? And at the YouTube channel, you can learn about what Axel's thinks and what he's doing. Ideal Wealth Grower. Well, listeners, there you have it. Another story of loss to keep you winning. My number one goal for the next 12 months is to help you, my listener, reduce risk and increase return in your life. To achieve this, I've created our community at myworstinvestmentever.com. So join to get also the discount for podcast listeners for the 6-week valuation masterclass bootcamp, where we value companies like Tesla, like we talked about today. As we conclude, Axel, I want to thank you again for coming on the show. And on behalf of A. Stotz Academy, I hereby award you alumni status for turning your worst investment ever into your best teaching moment. Do you have any parting words for the audience?
Anybody can be an investor.
Beautiful. And that's a wrap on another great story to help us create, grow, and protect our wealth. Fellow risk takers, this is your worst podcast host, Andrew Stotz, saying, I'll see you on the upside.